Coming up on Market to Market, the controversial energy policy of renewable fuels gets a tune-up. Arkansas farmers drift through more residue over a major herbicide. And dealing with the double whammy of weather in one coastal state. Those stories and market analysis with Dan Hueber next.
Be looking at ways to get...
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by SOYBEANS Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. SOYBEANS Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, July 7 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Those looking for work still had plenty of options for employment last month. The Labor Department said U.S. employers added 220,000 jobs in June, the most in 4 months, while the unemployment rate ticked up to 4.4%. Some of those new jobs may be in the energy sector. For the first time since 1984, the United States got more electricity in March and April from renewable sources rather than nuclear power. The Energy Information Administration said electricity production was driven by increases in the number of wind turbines and solar farms. Other homegrown energy sources include fuel derived from corn and soybeans. The biofuels business received mixed news this week from the EPA over 2018 blending standards. Peter Tubbs reports.
For the second year in a row, the Environmental Protection Agency has proposed lowering the amount of plant-based fuels petroleum producers are required to blend into domestic fuel supplies. The blending mandates are a contentious issue for both oil refiners and row crop producers, and the slight cut in the ethanol and biodiesel mandate signals a moderation between the two camps. We are proposing new volumes consistent with market realities, focused on actual production and consumer demand, while being cognizant of the challenges that exist in bringing advanced biofuels into the marketplace. The Renewable Fuel Standard, which was implemented in 2006, has resulted in almost all of the 143 billion gallons of gasoline sold in the United States annually to contain a 10% blend of predominantly corn-based ethanol. At the same time, more than 40 million gallons of diesel fuel used on the nation's highways contains a 4% blend of soy-based biodiesel. The National Corn Growers Association cheered the announcement. EPA's proposal is good for farmers who are facing tough economic times and good for consumers who want affordable fuel choices that give us a cleaner environment. Roger Johnson, president of the National Farmers Union, was disappointed.
As family farmers navigate a severely depressed farm economy, this is a time the administration should be raising expectations for a policy that drives many economies in rural America. We urge the administration to reconsider this action and to increase these proposed obligations to meet the levels as written by Congress.
The EPA also announced it will start technical analysis for a future reset of all biofuel mandates, including cellulosic, advanced, and other boutique fuels. For Market to Market, I'm Peter Tubbs.
The Environmental Protection Agency is beginning to walk back Obama-era rules concerning the waters of the United States as they define navigable waters. More on this story is available on our YouTube channel, Market to Market. The federal WOTUS has implications for nearly every operation, as do the rules over the application of chemicals. In Arkansas, state officials are setting policy being watched across farm country when it comes to drift. Colleen Bradford-Krantz reports.
An Arkansas legislative committee this week approved a ban on post-emergent use of DICAMBA herbicide. The emergency measure lasts for 120 days. Governor Asa Hutchinson had approved the plan last week after it was sent to him by the Arkansas State Plant Board. which has now recorded more than 540 complaints. These landowners report crop damage that they associate with a neighboring farmer's use of dicamba. The ban may cause problems for farmers who planted the new dicamba-tolerant Extend soybeans and cotton, although most may have sprayed weeds in advance of the possible ban. BASF's Ingenia was the only brand of dicamba approved in Arkansas for use during the growing season. Company officials have said they believe many of the problems stem from farmers' failure to carefully follow label directions, which suggest applying only in winds between 3 and 10 miles per hour. Governor Hutchinson said that while he realizes making a change during the growing season is less than ideal, the volume of complaints and the plant board's concerns justified the emergency measure. He asked the state's Agriculture Department and Plant Board to set up a task force to make long-term recommendations related to dicamba use. Arkansas state officials also agreed to move up penalties of $1,000 to $25,000 for those responsible for off-target applications that damage others' crops. Certain dicamba brands, such as BASF's Ingenia, will still be allowed for burn-down use in Arkansas fields or pastures between September 15th and April 15th. For Mark to Market, I'm Colleen Bradford Krantz.
Dry weather is tightening its grip on the grain belt. This week's drought monitor reveals 22% of the U.S. is in some form of drought. The most extensive is in the high plains, as nearly all of the Dakotas, plus Nebraska and eastern Montana, are dealing with parched conditions. Though hot and dry remains in the forecast for the region, the pattern can quickly change. As Josh Bittner explains in our cover story, producers in one coastal state are still recovering from a weather whipsaw.
Worldwide, perhaps no other vocation is more tied to the arbitrary essence of Mother Nature than farming. The elemental peaks and valleys can make or break a season or a life's work. And for producers in South Carolina, a demoralizing string of extreme weather events in recent years have created a struggle to bounce back from the brink of disaster.
At 2 o'clock Sunday morning, my wife woke up and she said, "Harry, it's whitecapping in the backyard." And I said, "What?"
In October 2015, 11 trillion gallons of water pummeled the Palmetto State, as between 10 and 20 inches of precipitation accumulated across the region in a 48-hour period. 35 of 46 counties were declared primary disaster areas, making them eligible for federal aid.
We haven't seen this level of rain in the Low Country in 1,000 years. That's how big this is.
Faced with an historic torrent, then Governor Nikki Haley deployed the South Carolina National Guard to assist with rescue, evacuation, and damage control.
Try to put that rainfall in perspective. The average rainfall for this part of the country in South Carolina is typically about between 40 and 45 inches of rain a year.
Leonard Vaughn, a hydrologist with the National Weather Service in Columbia, the capital city, adds that the deluge came on the heels of an extended drought that followed an unseasonably late freeze, a cycle that, soon enough, would repeat itself in an eerily similar fashion.
You're looking at some areas receiving nearly half their annual rainfall in a matter of 2 days. And so you can understand why there was so much flooding across the area and why we had so many issues with dams collapsing and bridges and whatnot being damaged due to the rising water and the heavy rainfall.
While getting goods to market on pavement proved to be a challenge, flowing floodwaters also gummed up ports and prevented a timely harvest. Many commodities were ruined in the interim.
Not good.
State officials reported $375 million in losses to agriculture alone in 2015. Those figures were later compounded as persistent wet conditions prevented planting of winter crops. In contrast with the near monoculture of grain and oilseed found across the Corn Belt, South Carolina counts softs, legumes, tobacco, and produce among its farming repertoire. And while that variety might lend a comparative advantage of sorts to local producers, on occasion, risk can outweigh reward.
We grow corn, wheat, soybeans,
and those don't bother me as much because we can insure them. But the vegetables are not an insurable crop, and that's why it hurts a lot worse.
2 months after the historic weather event, hundreds of farmers with no inventory to sell petitioned state leadership for a piece of the $140 million in federal funds Haley requested to assist besieged homeowners. The governor opposed a bailout for agriculture, saying crop insurance could cover much of the problem, and pledged to treat all South Carolinians exactly the same. However, the state legislature passed the South Carolina Flood Farm Relief Act in the spring of 2016, which the governor vetoed. Lawmakers swiftly overrode her action. Some farm associations described qualifications to recoup up to 20% of crop losses, capped at $100,000, as stringent, but expressed gratitude for the state's help.
It was a tremendously bad experience for a lot of farmers. Our state government stepped up and helped with a $40 million grant program to assist farmers who experienced 40% losses.
South Carolina Department of Agriculture Assistant Commissioner Clint Leach says the agency has recalibrated efforts to engage the public and inform how the industry affects the lives of all state residents.
South Carolina agribusiness is a $42 billion industry. It's the state's largest industry. And that includes about 212,000 jobs annually that's put right back into South Carolina's economy here.
Officials reported another late freeze followed by drought in 2016. But just as the natural perils of the previous October were beginning to fade into memory, a new violent weather system was barreling in from offshore.
We've been cursed, so to say, since 2015. It seems we always have one huge weather event sometime through the year that has affected everybody's decision-making a little bit.
Dean Hutto cultivates 3,700 acres of row crops halfway between the state capital and the Atlantic coast. Flooding wiped out his cotton harvest and decimated peanut and soybean yields. Insult was added to injury the following year.
The first week of October again in 2016, we had Hurricane Matthew came through, and we didn't get but about 14 inches that weekend, which seems kind of crazy to say, but it was welcome to only get that much.
As the Category 5 tempest plowed through the Caribbean and up the eastern seaboard, it made landfall in the PD region of northeastern South Carolina. According to state estimates, another $52 million in agricultural losses were tacked on as some crucial roads remained unrepaired following the first weather melee. Hutto himself feels lucky to have gotten away with a 10% cotton loss and several months of down tree cleanup. But it wasn't long before the young farmer's spirits were dampened. A spring freeze cut out 1/3 of Hutto's emerging wheat and obliterated roughly 90% of the state's peach crop, the worst loss in a decade. In recent weeks, another weather crisis was averted as meteorologists tracking Tropical Storm Cindy watched the system divert away from the Palmetto State. Many in South Carolina welcome the breathing room, but those struggling to regain a foothold on the farm are keeping their fingers crossed.
If we can make it all the way to December 31st without a humongous weather event, I think it'll pick up the spirits of South Carolina agriculture a little bit, because I feel like right now everybody is just kind of waiting on that next big hiccup.
For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
Confirmation of a weather-impacted wheat crop coupled with concerns of an unfavorable forecast for pollination pushed commodities higher. For the week, the nearby wheat contract had its highest finish in almost 2 years as the September contract gained 9 cents and the nearby corn contract flirted with $4, up 12 cents. Soybeans also moved on weather as the August soybean contract broke through $10, up another 54 cents this week. August meal added a whopping $26.30 per ton. In the softs, December cotton was even. Over in the dairy parlor, August Class 3 milk futures declined a dime. Livestock gave back much of last week's gains as the August cattle contract shed $1.52 and nearby feeders dropped $2.90. The August lean hog contract fell 52 cents. In the currency markets, the U.S. dollar index gained 35 points. Crude oil moved lower, $1.81 per barrel. COMEX gold hit a 4-month low with a drop of $32.60 per ounce. And the Goldman Sachs Commodity Index contracted nearly 7 basis points to finish the week at 365.65. Here now to lend us his insight on these and other trends is one of our regular market analysts, Dan Hueber. Dan, welcome back.
Thanks very much, Gray. I'm very glad to be here.
All right. In case you want to go over things again, you can listen to our market analysis and Market Plus podcasts anytime online at iptv.org/M2M. Now, Mr. Hueber.
Yes.
Watching this wheat market, Minneapolis wheat's been on a rocket ship of a ride.
Absolutely.
Has it come to an end? We saw it tumble pretty severely on Thursday. Friday backed off again. Are we done?
You know, to say we're at an end, I think would be a little bit premature. It was a breather, certainly. And, you know, when you have a market that really since the middle of April, and of course the majority of it in the last 4 weeks, has rallied over 50% off of its lows, it's entitled to a little stop to catch its breath, kind of look around, make sure the assessment is correct. So my bias right now would say no, I don't think we're necessarily done. But could we back up a little bit and kind of retrace some steps? Certainly, that would be normal in any kind of an advancing market. So.
Now, so that's Minneapolis wheat, but we've been watching the Chicago wheat contract. Of course, those are the numbers we just showed in the wrap-up. Chicago wheat has been pulled along as mini wheat rallied. Yeah. Given this break in Minneapolis wheat, given the fact that we still have, it sounds as though, ample stocks of the Chicago contract wheat, is Chicago going to begin to pull back more seriously?
Well, you have a couple elements, of course, at work. One, we came into 30 days ago with the wheat market with a still extremely heavy short position by the funds, so I think you've scared a lot of that money back out of there. Now, will they really have incentive to come back into the short side? I think not as much. And as you see these moves unfold, all of a sudden there's recognition that, you know, everything's not perfect around the world either. Here you've got a major drought happening in France, probably extending into Germany. There's been talk now that the Australian crop is going to be starting to trim back. So, you know, little by little, we're chipping away at what look like these huge, burdensome stocks. And here again, you have to come back to that whole aspect that if you kind of exclude the inventories that are over in China, the rest of the world does not have that big of a glut of wheat out there. So I think, you know, those small recognitions finally come about. So.
There's still some room here for this to move a little higher.
And not that we're going to get into, you know, the late 2000 type of massive bull markets. I mean, it's even when you look at this Minneapolis market and, you know, pushing above $8 and you compare it to what it was in 06, 7, and 8, I mean, it dwarfs the move, but I mean, that was an outlier. I mean, those are just kind of those freaky moves you might see once in a lifetime. But this is just a, you know, good old-fashioned bull market on weather-related issues, and you know, and of course, we've said all along this year it's going to have to be a weather event that's going to really spark things along, and finally we've got a little spark of that.
It has. It sparked things along. We've seen it in corn. As we look at the old crop corn contracts, both July and September's touching up against some one-year highs. How important is it for producers to get some of those old crop corn stocks moved on this rally, or do we let it run another nickel?
You know, and I think as with any marketing plan, you know, you really have to set targets. Yes, as we're at this $4 mark here, you need to move into it. Have your resting sell orders in place. We haven't changed the overall picture in the corn market that dramatically yet. Not that the next 2 to 3 weeks, particularly with our crop being a little bit behind normal, that can excite a few people and get them just a little bit anxious on having some inventory priced. But you know, when you look between, and I'm going to use December as the example, between $4 and $4.50, that has stopped the market for the last 2 years. Now, certainly, could there be potential to move beyond that this year? That potential is always there if weather really turns critical, but statistics would say, you know, you need to have your sell orders in that place and take advantage of this rally. If you need to come back and replace it on paper, you can always do that.
That's exactly right. And at this point in the game, would you, if you're making physical sales, would you re-own futures outright, either old or new crop, or would you just spend the money on some puts?
I would probably, I think puts might be the better alternative at this point. You know, one of the things that's been very interesting and works both good and bad, we've been so dead, so quiet up until this point. The volatility seasonally is exceptionally low. So you're not really paying those exorbitant premiums you normally would around the beginning of July. So it does make puts a little more attractive of a hedge purpose this year. Of course, the challenging aspect of that, usually when we look at buying puts, we like to sell calls to kind of compensate for some of the premium. Those calls have just not been, again, with 12 or 13% volatility, they just are not all that attractive.
That volatility is a sword that cuts both ways.
Exactly.
Saves you money when you're buying and doesn't generate you much more.
Right.
Now, as you take a look with the new crop sales, we do have a question, and you touched on it briefly. Matt in Amherst, Wisconsin on Facebook wants to know, is 450 corn a possibility? I mean, as we look at the setup of the spec funds in the corn market, how are they situated? They've been short. Has that changed?
They've been reducing that short position. I mean, certainly not have that. I haven't seen the numbers this evening. Not that they've gone to the long side, but they have over the last 2 weeks now have been slowly, kind of orderly reducing that short position. I guess I've kind of maintained all along that when you look over the last 2 years, and granted the acreage didn't come down quite as much as we thought, on the report a week ago, but we're still 3 million acres down from a year ago. We're 6 million acres less than 2 years ago, and in each of those 2 years, we've punched up and hit a 450. And granted, this low volatility has hurt us, but I think what you touched on initially is probably our ace in the hole. And I grew up in the philosophy or the market analysis philosophy, believing that wheat had to be the leader. If you don't have the wheat market moving, you're never going to extend a rally in the corn market, and that's. We've seen that picture change a bit here, maybe not 100%, but I mean, certainly you've got wheat leading the pack this time.
Yes.
So, yes, I still think that 425, 450 range is very doable here between now and probably, certainly no later than the end of August. But I mean, if we're going to have a weather issue, it's going to be in these next 30, 45 days.
Perfect. Now let's talk about soybeans. That's kind of been the story that's been left behind.
Sure.
But what an incredible rally. I mean, we're up, what, $1 now on some of the nearby contracts?
Exactly.
Holy cow. Where does this thing finish out?
Yeah, and of course, I mean, the turnaround is the great story there. If you went back 3 weeks ago, I mean, you would not be able to find anybody who would have had any kind of a friendly story at all to the soybean market. Yeah. But, that was the curious part about it all the way through is, when you looked at it from the fundamental side, you go, gosh, how could you even think about being positive on the soybean market? But when you watched the chart patterns and what was happening there, it never really reflected that. And, I guess after this many years in the business, I've tended to trust that technical picture, because oftentimes it will tell you something that's brewing below the surface that fundamentally we just don't know about yet. Ultimately, we'll learn about it after the fact. So, I mean, that's come to fruition. But, here again, too, there's no one major element. Weather is a concern. Granted, in travels here in the last week, I mean, the one thing I can consistently say is how short this bean crop is. I mean, and I've been through Illinois, across Missouri, now up into Iowa. A few weeks ago, I was across North Dakota and Minnesota. And consistently, the bean crop just seems very small. Now, that doesn't assure a lighter than normal yield, but, here again, too, this crop has not gotten the great start it has over the last several years where we put out these big above trendline yields. So I think that's part of it. You did see the conditions deteriorate just a touch last week, but I think the major element, once again, is the demand. It just does not quit in the soybean market. So
demand also hasn't seemed to have slowed down the live cattle market. We continue to see folks getting out there buying beef. We closed the week at 114, cash trade around 118. Have we found a secondary bottom here?
See, again, I think that's exactly what it looks like. We got the Chinese enthusiasm, even though we hadn't moved any beef over there up until in the last few weeks. But I mean, these are futures markets. We're always looking ahead. And I think now over the last 2 weeks, we seem to have found a little base, a little foundation again. So I think this cattle market looks like it's prepared to launch into the next level, at least go back and challenge the highs and maybe exceed those highs for a higher move yet.
All right. And feeder cattle probably going to follow right along as we continue to see profitability.
Granted, probably the biggest drawback on feeders, if we do really get the grain market moving a bit, psychologically that could work against feeders. But here again, if it is just 4 to 450 corn, nice hedge opportunity for the corn possibly, but I mean, probably not going to scare anybody out of the feeder market that drastically.
All right. Well, now let's talk about the lean hog market, because that's another one where demand has driven it. We saw cash hogs trading over $100 this last week. We do have concerns as we look out to the end of the third quarter, into fourth quarter, that we're going to be sweltering under massive supplies.
Right.
What are your thoughts? Have we priced that into the market already?
I think to a large extent, and I think the reaction after the hog and pig report probably reflected that. You know, here we came out 2-3%, we have, I guess, really a strong 3% higher in numbers all the way across, and the market still reacted higher. So, one of the great things I think that's happened in cattle and hogs both this year is we have seen, even the Chinese business, we've seen a great export business. And I think with the dollar as strong as it has been, a lot of people just assumed that was not going to be the case. So I think that has taken everyone by surprise, which has really been that element that moved us up to these highs and still seems to support both those markets.
Well, now you touched on the dollar. We have seen the dollar certainly looking to pull back. We're down around 95 on the dollar index. As you look around the globe, you look at Europe, you look at the situation in the UK, the Chinese government, where do you see the dollar trending? Are we still the best house in a bad neighborhood?
You know, we're still the best. You know, of course, a lot of the weakness, a week ago, the dollar did push down to the lowest levels since the election itself. And, you know, part of that was probably more of a psychological rally than anything, you know, of a real substance that was happening economically. Well, but that said, you know, the European Union or the European Bank a week ago came out and really said, we're going to aggressively try to stimulate the European economy. It does look like they were turning around just a bit anyway in that part of the world. So yeah, it's kind of strange. On a short-term basis, the dollar looks a little bit oversold, like it could see some rebound. Boy, you look at some historical long-term charts, that doesn't seem to be the case. I mean, I think we're I would tend to think we're at as good a levels as we're going to see, and could easily deteriorate lower over the next 12 to 18 months.
And we'll discuss that more in the Market Plus.
Very good.
Dan Hueber, thanks so much for taking the time to join us.
My pleasure. Thank you.
That wraps up the broadcast portion of Market to Market. However, as I mentioned, Dan and I will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and video form on our website. And while you're there, check out the classroom. This virtual schoolroom allows you to explore the science, technology, and business of agriculture. And join us again next week when we check on scientists exploring the use of genetically engineered insects. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by SOYBEANS Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, SOYBEANS Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.